Okay, and then the financing section I think is quite easy. Okay, it's very straightforward. Um, New loans, there's going to be cash coming in. Paid off loans is cash out. Bonds issued, cash in. Bonds retired, cash out. Common stock issued, cash in. Treasury stock purchases, cash out. And then when you pay cash dividends, that's cash out. And you're just going to list them, okay? And you'll just be, you'll see what your T account balances are. You'll be given information on, the increase or decrease in your liabilities. And you just have to uh, separate the issuances and the paying off, and make sure you're separating it, because you may have, like in this instance, right? Your starting balance of long-term notes payable. So notes payable, maybe your ending balance on your balance sheet and beginning. The net is going to be 80,000 difference. So maybe you started with 80K and you had 160K, right? Um, the net is 80,000, but as you can see here, it's broken out between new 90,000 being new loans and then paying off 10. Okay, so though the net change you're going to see on the balance sheet, you have to make sure that you're splitting up the cash in versus the cash out. Okay, so the balance sheet is only going to tell you the net change, and you will have to use whatever information is provided. Though in the problem, in the in your financial records, you'll basically have notes payable. You'll have whatever starting balance 80,000, and you'll have ending balance 160, and you'll have uh, 10K here and 90K here. And somehow the information, uh, you'll have the access to the information that will tell you how this is split out. But remember that it is split. Okay, you can't just look at the net change and just assume that you've taken on new loans of 80,000, because that's not right. You actually took out new loans of 90 and you paid off 10.